Beginning investors often have a lot of questions they want answered in order to help them understand what to look for in an investment. Things like the earnings per share, price to earnings, or even price to book ratios of the fund are often mentioned, but so are things like how long the investment manager has been with the fund, particularly if it is an actively managed fund. And then of course there are things like the candlestick and other charts, recent momentum of the investment, and the growth potential of the investment, which, as you can imagine, is pretty hard to pin down and can often vary from investor to investor. But when you get right down to it, assuming you are investing long-term and in reasonably well-diversified funds, you may not actually need to go into quite so much detail to build an investment portfolio that's likely to perform well for you in the long term. That doesn't mean you can't get anything worthwhile from those more systematic analyses, because of course you can, but it may not be necessary to get a decent idea of how your net worth is going to grow over time. As it turns out, there are roughly 7 factors that do a fairly good job of giving you an idea of whether an investment portfolio is likely to perform well for you in the long run. And that's what we're going to be discussing today. Let's talk about some of the biggest factors that influence the growth of your nest egg and how you can optimize your investment plan to get the most out of your money. But before we get going, be sure to like this video if you haven't already, as it really does help out the channel a lot, and subscribe with notifications on for more money-related videos like this one every single week. And if you want to further support this channel, you can check out some of the links I've left in the description below, which includes a link to the investing platform M1 Finance. Get started investing for free today. The 7 factors that heavily influence the bulk of your portfolio's performance are how much money you save, often referred to as your savings rate, how long your investments compound, in other words, your time horizon, your asset allocation, or how you divide your portfolio between stocks, bonds, and other types of assets, those assets' annual returns, how much you pay in expenses, how much you pay in taxes, and your behavior as an investor. That's about all there is to it. Granted, we can't know what the exact future returns of our investments will be until they actually come in, but we can look back at history and get a general idea of the range of likely returns and use that to ballpark our ending figures. As for the rest of the factors, we can get a pretty darn good answer to each when looking at our portfolio and other aspects of our financial picture, like our risk tolerance, behavioral tendencies, and budgets. So let's go over each of these factors to understand why they're so important to projecting the growth of our net worth and how to maximize the value of each factor to get the most out of our money. The first factor influencing the growth of your net worth is your savings rate. This one doesn't require much of an explanation. If you put more money into your investments, then, all else being equal, you'll end up with a larger net worth down the line. In order to make the most out of this factor, you'll want to ensure that you're being as efficient as possible with your expenses, limiting financial waste as much as you can, and ensuring that unforeseen external circumstances don't set you back unnecessarily. You can accomplish these things by doing a few things. First, make sure that you're tracking every penny that you spend each and every month. An easy way to do this is to use a debit card for all your purchases and then download your transactions from your bank to see where your money is going. If you categorize your expenses, you'll be able to see if you're regularly spending money in areas that you don't want to be spending money in and find a way to limit or cut those expenses, and therefore lower your financial waste. You'll also know where to start researching for more cost-efficient ways to meet your ongoing needs and wants. Second, you can use the 72-hour test to limit impulse buys. The 72-hour test is a simple technique that you use when you stumble across a product or service that you might want to buy. You force yourself to hold off on buying it for at least 72 hours. If, at the end of those 72 hours, you still want the thing as much as you did when you originally stumbled across it, then by all means, buy it. Because you can at least be reasonably certain that this is in fact something you genuinely want and are likely to enjoy. If not, then, well, congratulations! You've successfully avoided buyer's remorse and saved some money at the same time. Third, you'll want to align your spending with your values as much as you reasonably can. Take some time to reflect on your spending. Are there any discretionary expenses that you don't feel you're getting your money's worth from? This can be difficult to feel for sometimes, so consider experimenting with temporary cuts to certain spending areas to see how much you actually miss them. A lot of times you'll find that you don't really miss the things you used to buy very much, and in those cases you'll be able to safely cut or limit those expenses and move that money into other areas of your budget that you hold in higher regard. Fourth, you'll want to regularly try new, low-cost activities that you feel you might enjoy. If you can find enough of them to occasionally do in place of other, higher-cost activities, you'll be able to raise your savings rate even higher. And fifth, you can build a strong emergency fund to ensure that those external circumstances don't force you to either withdraw money from your investments at the worst possible time, or run up a hefty credit card bill that you'll then have to put your future savings money towards paying off. The second factor influencing the growth of your net worth is your time horizon for your investments. Again, this one doesn't require much of an explanation. The longer your investments have to compound, the more they'll end up being worth at the end of the day, all else being equal. And there really isn't a whole lot to make the most out of this factor either. I mean, assuming you've got your emergency fund and other aspects of your financial situation in place, i.e. you've got a solid investment plan worked out, and you're not drowning in debts or something similar, then just start investing as soon as possible. The third factor influencing the growth of your net worth is your asset allocation. Now, when I say asset allocation, I mean the portion of your money that you're investing in specific types of investments, like stocks, bonds, or real estate, not the specific stock, bond, or real estate fund you choose. Because most assets of the same type will perform fairly similarly to each other, or at least much more similarly than they're likely to perform compared to something in a different asset class. So just by looking at the percentage of your money that's going into each type of asset, you can get a pretty decent idea of what your results will be just based on how these types of investments have performed historically. For instance, if you're investing all of your money into the stock market with nothing going to bonds or real estate or anything else, we can be pretty sure that you're going to experience some pretty significant volatility from time to time over the short term. But relative to someone who puts all their money in bonds, your long-term returns as an all-stock investor are likely going to be higher. Making the most out of this factor really comes down to knowing yourself, your goals, and your financial situation. For instance, if John has a long time before he'll need the money from his investments, say like a few decades, and he's willing and able to stomach the higher levels of volatility that's often associated with the stock market without panic selling, he may very well be better off leaning heavily into the stock market for his portfolio. However, if he was anticipating needing the money sometime within the next couple of years or wasn't confident that he'd be able to weather the storms when they came without doing something that he would later regret, he might be better off lowering the percentage of his money that's going towards stocks and putting a little extra into some kind of bond fund, since they've historically been more stable and consistent as an investment type, even if their long-term returns haven't been quite as strong as stocks. There are a variety of metrics that you can look at to get an idea of what type of investment is right for you, and you can even check the historical performance of various asset classes online using tools like Portfolio Visualizer. But some of my favorite metrics are probably the long-term and risk-adjusted return metrics like the Sharpe and Sortino ratios, the standard deviation of historical returns, since that gives you a general idea of volatility, start date sensitivity, which is basically a luck factor of an investment because it illustrates the amount an investment over or underperforms its rolling returns over a specific time period. For start date sensitivity, the lower the number, the less luck is usually involved in generating the historical returns that you're seeing on average. Portfolio Visualizer's tools don't actually have this metric, but I do have spreadsheets on my Patreon page for those in the investor tier or higher that do include it while still allowing you to backtest your allocations just like you would on Portfolio Visualizer. Shortfall avoidance is another good one, which basically measures how often an allocation has historically managed to meet or exceed a specific return target over a specified period of time. This is another one that's in my asset allocation spreadsheets over on Patreon. There's also the Ulcer Index, which basically measures how stressful of an investing experience a particular investment or portfolio would have been historically by taking into account how far those investments fall in value during tough times and how long it typically takes them to recover. And then, of course, there's things like the safe and perpetual withdrawal rates, which are very important for financial independence planning. The fourth factor influencing the growth of your net worth is the returns you earn on your investments. Again, another fairly obvious one. With higher returns comes a larger nest egg. Now this one, as I said earlier, is really tough to nail down and tough to make the most of in a strict sense, because the returns of an investment will be whatever they'll be. It's largely out of our control as individual investors. However, by doing things like investing more money than you normally would during market downturns, you can still end up with a larger net worth at the end of the day than someone who simply invested the same amount of money each month, even if you end up temporarily dialing back your ongoing investments after the market recovers. Just as a quick example of how this can work, take a look at this chart. It shows John and Jane's annual out-of-pocket investments, the performance of that investing, and each of their net worth figures over a hypothetical 5-year period. John invests the same amount each year, in this case $1,000, while Jane invests an extra $500 a year when times are tough and then temporarily dials that back after things go back to normal. At the end of the scenario, both John and Jane have actually invested $5,000 out of pocket, and both are set to invest $1,000 a year going forward, but because Jane put more money in when the investments were on sale, her net worth is a little higher. As you can imagine, the differences only grow larger over longer periods of time with larger ongoing contributions. The fifth factor influencing the growth of your net worth are the expenses you pay to hold your investments. This is important because the expenses you pay for your investments typically come right off the top of the value of your nest egg. A 1% expense ratio on a fund means that owning the fund will cost you 1% of the value of your entire investment each year. A sales load on the fund will cost you whatever the percentage the fund charges on the entirety of your contribution or withdrawal, or sometimes both. Trading costs, whether in the form of a bid-ask spread or some kind of interest expense related to certain trading strategies, puts you slightly in the hole right from the get-go. Over time, these expenses can make a huge difference in our overall net worth. For example, if John had $10,000 to invest and had to choose between two funds that were investing in very similar assets, which historically return 10% per year before expenses over the long run, but one had an expense ratio of 0.05% per year while the other had an expense ratio of 1% per year, do you know how much of a difference John would see in his net worth if that money were invested for a full 40-year working career? It's over $130,000. 13 times his original investment. Assuming both investments actually earned their historical 10% average returns over the course of that 40-year period, the low-cost fund would have grown to over $444,400, while the high-cost fund would have only grown to $314,000. And of course, that difference would have been even larger had John been regularly adding to his investments during that time. So naturally, all else being equal, we want to keep these expenses as low as possible. We do this by eliminating unnecessary trading, choosing the funds that have the lowest expense ratios possible unless we have a darn good reason for not doing so, such as the lower cost fund not fitting into the portfolio we want to build, or having a firm and well-reasoned belief that the more expensive fund will be able to outperform the affordable fund by a wide enough margin that it makes up for that difference in costs. And of course, whenever possible, we try to avoid funds that charge large fees to enter or exit. The sixth factor influencing the growth of your net worth are the tax costs associated with your investments. As they say, there's only two certainties in life: death and taxes. And while there are several strategies you can use to make your investment-related tax burden incredibly small, there will usually be some taxes due eventually. These taxes usually come in a few forms: capital gains tax, whether short or long term, dividend or interest income taxes, withdrawal taxes when you pull money out of a traditional 401k or IRA in retirement, tax penalties, which are often incurred when you withdraw money from a tax-advantaged account early for an unapproved reason, and turnover-related taxes, when you own a mutual fund or some other fund that sells investments within the fund for a gain. In order to minimize these costs as much as possible, it's often a good idea to invest in tax-advantaged accounts, such as a 401k through your employer, an IRA that you set up yourself, and an HSA for those who have high-deductible health insurance plans. If you're investing in taxable accounts, it's generally advisable to hold your investments in that account for at least a year plus 1 day before selling them for a profit. That way you'll at least be able to pay the long-term capital gains taxes on those profits, which are usually much lower than the tax rates for short-term capital gains. Here's a chart showing the long-term capital gains tax rates for 2021. You'll notice that if your taxable income is low enough, you actually could be paying 0% in long-term capital gains taxes. Pretty sweet, huh? You may also be able to utilize a technique known as tax loss harvesting in years where you want to sell some of your investments for a profit. Tax loss harvesting is a technique where you sell some investments that have gone down in value, which creates a capital loss for income tax purposes, during the same year when you sell some of your investments for a gain. The hope is that these two sales essentially cancel each other out, and that leaves you with little to no capital gains taxes to pay. Though even if it didn't, it does still lower the amount of taxes you owe. So if you're looking to get out of those investments that are down on their luck, this could be something worth considering. The seventh factor influencing the growth of your net worth is your own behavior and decisions. As I mentioned in the investment returns section, choosing to sell your investments, or even just stop investing, during a market downturn can diminish the overall size of your investing nest egg, especially over longer periods of time. But that's not the only thing to keep an eye out for. Other common traps that investors have fallen into include engaging in high-risk and potentially high-cost trading strategies, such as day trading or leveraged investments, which, granted, can sometimes work out well for investors, but history suggests that over the long haul, more often than not, it doesn't work out as well as the more traditional approaches. Not having a good financial team around you, such as a good financial advisor who can help talk you off the edge if you're about to make a decision that you'll later regret, or a good tax pro which can help you further save money on those income taxes, and following financial media too much. By its nature, the financial media tends to focus on the here and now. It's their job. Timeliness is part of being newsworthy. But sometimes we can focus a little too much on the here and now and lose some perspective as a result. During tough times, this can make us very uneasy about the state of things and lead us to making decisions that we later regret. During good times, it can also lead us to irrational exuberance and cause us to make decisions that we'll later regret, such as buying into a bubble shortly before it pops. So in order to ensure that we don't become our own worst enemy, it's important to educate ourselves in the world of finance and understand what we want to get out of our investments. That way, we can, with the help of our financial team, build a plan that we're going to be able to stick to through thick and thin and live the life that we deserve. So those are the 7 major factors influencing the growth of your net worth. When you get right down to it, most of our success or failure come down to our ability to save enough of our income to get and keep the wheels turning, stay in it for the long haul, select an asset allocation that's aligned with our goals and personal makeup, keep our costs as low as possible, and not shoot ourselves in the foot along the way. But what do you think? Are there any other major factors that you believe I've missed? Let me know in the comments section below. But that'll do it for me today. Once again, if you enjoyed this video, be sure to smash that like button if you haven't already, subscribe, and hit that bell next to my name so you'll be notified of all my future uploads. I generally upload every single Monday, and if you have a friend that would be interested in this kind of content, be sure to share it with them. Let's really get this information out there and start our own financial revolution.